Okay, let's take a look at this problem which deals with general ledger relationships as they apply to under and over allocation situations. And this is problem 4-36, which you see on the screen. Okay, so we have the Needham Company in front of us. They use a normal costing for its job costing system. And we have the partially completed T accounts and additional information for Needham for 2006 appearing in these T accounts right in this area. And then we have a series of, or 3 items of additional information. Direct manufacturing labor was $15 per hour. Manufacturing overhead was allocated at $20 per direct manufacturing labor hour. And during the year, sales revenues were $1,090,000 and marketing and distribution costs were $140,000. Okay, and they do say they use a normal costing system. So let's take a look at number 1. What was the amount of direct material issued to production during 2006? Okay, and I'm going to just work this one down here. What we can see from here is if we look at the direct materials control account, we can see that it looks like we started off with 30,000 to the left of my mouse, and we had purchases of 400,000, but something was released of 380,000. And so to answer the question, what was the amount of direct materials that was issued to production, it's that 380,000. So that's the correct answer, and I'll just jot that down for part 1. Was issued to production. Okay, 380,000. Let's take a look at number 2. Number 2 says, what was the amount of manufacturing overhead allocated to jobs during 2006? Okay, let's take a look at this now. All right, let me make a little bit of room so we've got some room to work here. All right, on number 2, what we do see is that in the work in process control, we see that they've identified $360,000 as relating to the direct manufacturing labor. So what I think we need to do here is calculate the direct manufacturing labor hours. Okay, and direct manufacturing labor hours would be equal to the direct manufacturing labor hours would be equal to the direct manufacturing labor costs, right? So why don't we type in divided by the direct manufacturing wage rate per hour, right? And so that is going to be equal to the cost we see from the T account was $360,000. And we know that direct manufacturing labor wage rate was $15 an hour. So if we divide that out, we come up with 24,000 hours. Okay, now if we know that that's 24,000 hours and they allocate manufacturing at $20 per direct labor hour, and just to show the math, I'm going to type in the 360,000 divided by 15. It gives us our 24,000 hours, right? And then I'm going to multiply that times the $20 per direct labor rate. I'm sorry, I want to call that the $20 manufacturing overhead allocation rate. And then to answer number 2, we can simply multiply the 24,000 times that $20. And I'm just going to enter the $20 since I didn't put it in a cell. And we come up with manufacturing overhead allocated of 480,000. Now let me bold that so we know that that's the answer. And let me bold this as well so we know that that is the answer. And I'll put a $, put no, and take away pennies. All right, now let's take a look at number 3. Number 3 says, what was the total cost of jobs completed in 2006? All right, if we look at the T account, let's take a look at what we see. We see in finished goods, it started with 10,000. It looks like 940,000 was transferred in and 900,000 remained. Well, the transferred in it tells us exactly what we're looking for. It's the cost of jobs completed and transferred in when we're using a normal costing system, and I believe that's what they say right here. Normal costing, we could look into the T accounts to find out what that dollar amount is. And so that is simply 940,000. So let me format this cell like that, and I'll type in 940,000. Okay, so it's the amount transferred in. We can see that right there. All right, what's number 4 say? 4 says, what was the balance of work in process inventory on December 31st, 2006? Okay, now let me slide to give us a little bit more room here. Well, actually, let me slide back down so we can read it. I'll try to work it in here. Now, we're not seeing all of this. We're only seeing partially completed T accounts, so we've got to make some conclusions about what we see. Okay, so to answer number 4, what was the balance in work in process? I'm just going to start typing in what we know. Start typing in. We know we started with 20,000. Okay, and we see that right there to the left of my mouse. Okay, then we also transferred in 380,000, and the reason we know that is we see a credit to direct materials control. Well, that moved into work in process, so we need to add in that 380,000. Okay, and then now they do tell us direct manufacturing labor of 360 was added, right? And we talked a little bit about that earlier, so that should make sense. What else do we have coming in? Okay, we also need to include that direct, the answer to number 2, the amount of manufacturing overhead allocated to jobs to 260. So the 480,000 of overhead also went in. Okay, so we're taking care of material, we're taking care of the labor, we're taking care of the overhead now going in, and then we saw the finished goods coming out, right, the 940. So also in that work in process control, we would see 940,000 coming out as all of the units was completed or were completed. And that's 200. So we back out the 940,000. All these others represent increases of materials, of labor, of overhead, right? And we're able to come up with the total amount of work in process inventory, and I'm just going to abbreviate this as WIP inventory of 300,000, and that's the right answer. Let's bold that, and we'll make that look similar to these others. Next we tackle number 5, which says, what was the cost of goods sold before proration of under or over allocated overhead? Okay, well, if you look at the credit entry to finished goods T account, you see the cost of goods sold before any proration was the 900,000. And that's really all there is to number 5. We'll bold that, turn that to this, make it look the same, and then we can move on to number 6. And number 6 says, what was the under or over allocated manufacturing overhead in 2006? Okay, I've slid and made a little bit of room. All right, well, what did we have? We had debits to manufacturing control, to our manufacturing overhead control account, equal to the 540,000, right? Slide back up here. Minus the 480,000. Now, let's go find out where that 540 came from. And I think we posted that in here somewhere. Oh, my mistake. Actually, the 540,000 is given right here. Manufacturing overhead control of 540,000, right? And what we saw was we had determined that the amount of overhead to apply was equal to the 480,000 that we calculated allocated to jobs in number 2. So this is equal to 540,000, right? And then we can back off the 480,000. I'm just going to show that as a negative. And then we'll combine the two, and we come up with 540,000 manufacturing incurred less the 480,000 applied to jobs. So what we have is a $60,000 under-allocated amount. Okay, and that there is the answer we're looking for. And we'll drop that in there. All right, now we look at number 7. And number 7 asks, dispose of the under or over-allocated manufacturing overhead using a write-off to cost of goods sold or a proration based on ending balances. And base it on ending balances before the proration in work in process control, finished goods control, and cost of goods sold. Okay, let me adjust the screen here. All right, well, if we want to do part A, and I'll just write the answer over here, we know from above that we already had a cost of goods sold that was equal to the 900,000, right? We finished it, we finished the goods, and using normal costing we had 900,000 carried in our work in process. So let me slide on down here. Under 7A, the write-off of cost of goods sold would be an increase by that $60,000. So it would be equal to the 900,000 that was transferred to finished goods plus $60,000 more of the underallocated. If I can type it right. 60, there we go, 2 zeros. So that gives us our answer to part A. Now part B requires just a slight allocation. Okay, now our demo is getting fairly long, and rather than work through the allocation, what I'm going to do is show you what the solution should look like to 7B. So let me move this over, and now you can see it on your screen. What we would do is we would start off with the name of the accounts. We would enter in the account balance before the proration, and it's 300,000, 50, and 900,000, right? Figure out the percentage of each of those general ledger accounts. And then we would prorate the allocation based on those percentages. So we take 60,000 times the 24% that represent work in process, 60,000 times the 4% that represents finished goods, and 60,000 times the 72% that makes up cost of goods sold. Multiply it across, and we would come up with the allocation, if you will, or the proration of the 60,000 underallocated to those various accounts. We would make the journal entry, and then the accounts would appear to the left of my mouse as you see there after doing the allocation. I will also point out in my experience, typically if the dollars are small, I've seen part A be used in practice. However, if we've got a significant dollar amount, it probably is more theoretically accurate to go ahead and prorate it to the various accounts so that we restate each of those counts as accurately as possible. And that takes care of 7A and B. Next we move on to parts 8 and 9. Okay, now I've slid back up so we can capture that information in number C again. During the year, sales revenue were $1,090,000 and marketing and distributing costs were $140,000. And here too, to save time, I've gone ahead and shown the solution, and let me explain it to you. Okay, so I'll slide on down, and now as we see number 8's on the screen here, what we can see is there's the $1,090,000 showing it both ways. There's the cost of goods sold, assuming we wrote it all off under 7A to cost of goods sold, it'd be 960, but using what we did under 7b, it would be the 943,200 to the left of my mouse there. And we have gross margin then that's slightly different, and marketing and distribution costs are the same, that 140,000 in either case. So what we're able to do is compute what the operating income is based on the method we use to dispose of the under allocation of overhead using a normal costing system. Okay, now I've slid back up just so that we can see number 9, which says, which approach do you recommend in number 7? Do we write it off to cost of goods sold, or do we prorate? And I think you can see that the proration is technically more accurate, but the write-off to cost of goods sold is easier, but also you can see that there is an impact on operating income. So that's something to keep in mind. Theoretically, the proration method is superior. Thanks, everyone.